Okay, holding out steady, and we're bracing ourselves for a fresh all-time high on the Nifty. So at a time like this, who better than Laurence Balanco from CLSA joining in to talk about what he's seeing on the charts for the Nifty, both in the near term as well as the long term. Laurence, great to have you on the show. After a bit of an aberration, seems like global markets are going to sustain a move upwards for even the India markets. Help us understand, what is it that you're reading on the charts for Nifty? Because we've also been marred with a fair amount of volatility and correction, given the kind of volatility in the US bond yields.
Yeah, morning. Thanks for the introduction. Basically, the trend that you've seen in the Nifty since the March lows is still intact, and the key support area has been the 50-day moving average. So if you look at the sell-off that we had from the February highs, that's where we found support. So that's roughly at the 14,300 to 14,400 area. And really what's generated from that has been a trading range or consolidation pattern, which is no surprise considering the strong trend that we've had of the March lows, and even if you just look at a shorter term from the October 2020 lows. So we think there's likely to be a further volatility in this range, but ultimately clearing through the 15,500 area, we've got our next upside target at 16,500, and we still have longer term objectives for the market up towards 18,000 on a longer term basis.
Sure. As a trend, Laurence, sectorally, what is it that you're looking at? What's going to be the composition of the Nifty, and what's going to take the Nifty higher? Where is the leadership emerging? Because, you know, post the pandemic last year, you saw a recovery in IT-Pharma play out, which actually spread its wings across to autos and other sectors. And then off late, you've had banks as well participating in the rally. Where do you think the next leg of the push for the index is going to come in from?
I think it's definitely centered around the banks and CNX Banks Index driving it. So yeah, going through the recovery of the March lows, you basically had technology and pharma leading that. Those two sectors, and pharma in particular, sort of peaked out last year, October 2020, and you've seen some relative underperformance. That has been generated by a simple trading range. But the key sector driving us towards the 16,500 and a longer term target of 18,000, we see the banks being the key driver there. And one of the lagging banks has been the PSU banks, which we now see participating. So in addition to the broader banks index, you've got the PSU banks coming through and supporting that new leadership drive.
Okay, fair enough. In terms of the, just before we talk in terms of, further pockets, but in terms of the risk on the downside, Laurence, and you also alluded to that already, but how much further do you feel we could overshoot on the downside as well, if that were the scenario? I mean, how much are you really factoring in there?
Look, we're looking at a number of markets across the globe, essentially been in trading ranges since late January. So if you even look at the NASDAQ, you peaked in the February, you've pulled back, you found support around the 12,200. That's where we've had the recovery this week. If you look at the S&P, you corrected back towards the 3,700, 3,800 area. You've rebounded from that to make new highs. So broadly, these markets have been consolidating for a 2-month period, and the correction that you've seen through February and even late March has found support at a very similar area for most markets. So you're basically talking about a 5 to 10% trading range. So that's really what's developed. So you'd essentially have to break below the lows that we made late February, early March, and the January lows to suggest that you've got another further 10% downside. So if you're talking about what's the overshoot or potential risk to the downside, breaking the recent lows and the late January lows would suggest another 10% downside. And then most markets, you're talking about the 200-day moving average as the next key support zone for them.
Okay. Would that actually make valuations in terms of an EM play a little bit more attractive when we're looking at India vis-a-vis some of the other markets that you're touching upon as well?
Well, let's go just broader emerging markets. Emerging markets versus developed markets have had a significant period of underperformance since 2010. what we've seen over the past 12 months is that relative underperformance has actually flattened out and started to turn up in favor of emerging markets over developed markets. And from a chart perspective, we think there's a major low in place for emerging markets versus developed markets. And over the coming 24 to 36 months, we think you want to be overweight emerging markets relative to developed markets. So this recent pullback that you've had in emerging markets relative to DM, we think is an opportunity to add exposure. Now, India, over the past 6 months, has been a great outperformer relative to other emerging markets. And on a longer term basis, we think it still will be a leadership within emerging markets. But in the short term, we see some give back as the Nifty consolidates in its current range. But longer term, we still see it as one of the leading emerging markets and emerging markets outperforming developed markets.
Sure. Laurence, want to understand where is it that you see the yield as well headed? Because, after what we've seen in terms of the sizable stimulus that got approved into a bill, we've seen the risk-on rally back globally. You've got the dollar index at 91.4 and US bond yield at 1.53. Where do you think these two are headed next?
Okay, so let's start off with yields. And the one thing that we've been highlighting to our clients is that the actual level of the 10-year is not as significant for equity investors. It's a rate of change at which yields have risen. So we've shown some back testing over the past decade, and where you see an accelerated advance in those 10-year yields by defined 20% gain within a 4-week period, that's what's generated these short-term pullbacks. So I think that's already played out. Where we see yields currently is consolidating between 1.3 and 1.7%. That is the range that we think will develop over the next 3 months, and then gradually move up within the range of 1.3 to the top end of that range at 3%. But a grinding move, I think the markets can digest. If we do see another reacceleration in yields to the upside, gaining over 20% over a 4-week period, then I think markets will again be vulnerable to some volatility and corrective action. But as you see it currently, we're setting up a new trading range and consolidation between 1.3 and 1.7. So that's the view on the 10-year yield. On the dollar index, if you look at the DXY, our longer term view is that the price action over the past 18 months is the topping process of the US dollar. The dollar had been in an uptrend off the 2011 lows. And over the past 18 months, you've seen a top develop. So we see the recent rebound back to this 92 to 93 area, which is coinciding with a falling 200-day moving average for the dollar index as an opportunity to sell dollars, looking for the downtrend to continue and a break below the January 2018 lows. So we think the dollar index is putting in an important top here.
Interesting. Coming back to India, Laurence, and given that you do see strength in banks going forward, help me understand what levels do you foresee on the Nifty Bank in particular, both in the near term as well as the longer term?
Yeah, so short term, we still have an outstanding upside target of 40,000, and that was when the index cleared through the 2019 highs. So that was the old resistance area around the 32,700. So we think that turns into support. But ultimately, we see this index pushing up towards the 55,000 area. Obviously, we will have pullbacks on the way to that kind of target. So short term, looking at 40,000, then a consolidation, but ultimately pushing towards the 55,000 area.